As inflation soars, new data shows many Americans are charging it.
I'm just concerned if that's a bubble that you're watching.
We do watch those things.
Debt. What do you think of when you hear this word?
We have an affordability crisis in the United States.
Everywhere you look, the color is red.
We're all taught to think of it as a crippling obligation. But debt is one of those things that makes the world go round.
Credit card debt has jumped 13% in 1 year.
We want to be able to buy a house, and we don't have a house yet.
Buying a house, starting a business, investing, funding tuition, debt can be used to finance all of these.
Credit card debt.
Definitely you want to be paying down the credit card debt.
The food costs are going up, energy costs are going up, rents are skyrocketing.
Debt is going up so that we can pay the interest on the debt that we have. I don't think it's going away anytime soon.
So what misconceptions do you have about it? How does debt really work? Private debt can be divided into two kinds, for consumption and for investment. It can also be divided into personal and corporate debt, who borrows the money. Debt for consumption is often for credit card use or for big ticket items like houses, cars, and tuition fees. Imagine if you had to save up to buy a house. You wouldn't move in until it was time to retire. Debt lets you have it today and pay for it tomorrow, usually with interest, of course. What causes lenders and borrowers to come together then? When we value how much money is worth to us, we also take into account when we have it. The same amount of money is worth more today than tomorrow. If I can buy something with it now, it's better than later. A borrower may see money in the future as being less valuable than money now. And the lender may see future money as being more valuable than the money they have now because there's nothing better they can do with it at that moment. It's an exchange that works for both parties.
Here's Justin McQueen, our market specialist, with the lowdown on how borrowing works.
Borrowers borrow money, they can invest it in R&D or other investments or even receive interest on that. Because lenders recognize this, to lend out money, they would therefore ask for a premium in the form of interest, so they get paid by lending out the money.
The time value of debt for investment works the same way. This kind of debt is known as leverage. Leverage is used by corporations and traders to invest for a return. Companies can borrow to fund new ventures that make all the things you like to buy. And investors who make a good call can magnify their returns using someone else's money. Take US corporate debt. It's been on a continuous upwards trajectory going back to 1980. This spiked at the start of the pandemic, reaching over $7.5 trillion today. So with interest rates rising, are US corporate debts sustainable? Debt isn't as simple as being a burden you should avoid or a limitless source of cash. Now that we've been over how debt is structured, we can look at the bigger picture. What's this all for? Sure, I'd like to live in a house now, and of course, I'd like to be able to pay for that nice car. So why does the bigger picture matter to me? Debt makes the economy go round. It fuels consumption, funds investment, and central banks use it to control inflation. Credit means you can have the money to fund your purchases now rather than later. This stimulates demand, and more consumption means more economic output. Interest rates are the cost of credit, and by extension, the cost of money. The lower it is, the cheaper it is for you to borrow. The cheaper the money, the more you can afford to borrow. Central banks control base interest rates. By raising rates during times of high inflation, they can make borrowing more expensive, cooling down the economy and lowering inflation. We've also made a film about this subject, which you can watch by clicking on the link. After 2008, central banks lowered interest rates to all-time lows. They did this by controlling the base rate and raising bond prices with quantitative easing. This was to get the economy moving out of recession and create inflation by stimulating demand. Here's Justin again.
Essentially, a central bank would buy government bonds, which would therefore mean that the price of the bond increases, the interest rate on the bond will therefore decrease, and subsequently that would allow for more borrowing to take place within the economy and therefore generate inflation going forward.
This demand goes both ways, stimulating investment by making it cheaper and fueling consumption of those big ticket items we mentioned earlier. US credit card debt from 2013 to 2020 had been climbing, a consistent trend upwards for years, until the pandemic upended old consumption patterns. The recovery has seen a return to old habits, but at a lower level. It currently sits at $890 billion US. College debt, or uni for you Brits, can be a big burden to young graduates. In the US, student debt is even larger than credit card debt was at its peak in 2020. And on average, American graduates owe around $37,000 for tuition fees. Given that the US rate of inflation is at decades-long highs and rate rises have been coming thick and fast, we need to get into what America's household debt situation is really like. While debt makes the economy go round, too much of it can hold it back rather than help it. When private debt in the economy gets too high, it just can't be repaid. This is called debt deflation. Credit is money. When it's lent out, new money is created and added to the money supply. When debt is repaid, that money is destroyed. But when private debt levels grow too large, it cannot be paid back without increasing the real value of the remaining debt, leaving the real value of debt exactly where it was. Is the US in this situation? We can only speculate, but it could be in a debt deflation cycle. Let's look at total US private debt. When looking at the total scale of debt, it's useful to look at debt to GDP ratios rather than just the raw figure. This is because the ratio to GDP will show how affordable it is. US private debt to GDP levels stand at over 220%. This is lower than it was in 2020 when it peaked, and it's even lower than it was in 2007. So while the US may have high debt levels, which can't be ignored, over the past 2 decades, its private debt burden has remained steady. The same cannot be said for mortgages. Mortgage debt levels are even higher now than they were in 2007, just before the 2008 housing crash. If you want to know more on whether there could be another real estate crash, click here to watch our recent debate on the subject. It's really interesting. And let's not forget about US auto. They too are on a similar trajectory to mortgages, heading onwards and upwards. Auto loan debt in the US currently sits at $1.5 trillion, even higher than credit card debt. Private debt in the US doesn't all work the same, but almost all of it's going in one direction, up. And that's kind of worrying. Is this just what happens when economies grow? The thing is, US private debt to GDP hasn't increased much over the past 15 years. Or is it rising just because of low interest rates? And what will happen to all this debt as rates rise?
While rising interest rates from various central banks, most notably the Federal Reserve, will make it a lot harder for companies who have over-leveraged on near enough zero interest rates, it will be much harder for them to service that debt next year. Now, of course, that can probably lead to companies facing the risk of bankruptcy, but the US as a total, I think the rate of change that we've seen since the COVID crisis is not sustainable, but the total level itself, I would argue that is still pretty sustainable.
Interest rates are rising. This is a fact of life that economies will have to deal with until inflation is tamed. But how high could they go? Yep, you know the drill. We've also made a video on that topic. You know where to click, but we're almost finished with this narrative, so just bear with me a little bit more. On a related note, how high could inflation go? I mean, how long's a piece of string? What we do know is that inflation in many Western countries has been persistently high, reaching highs of 10% in the UK and 8.5% in the US. Fed inflation targets are 2%, and the only tool central banks have to fight inflation is rate rises. Rate rises mean the cost of future borrowing gets more expensive, and the cost of servicing existing debt goes up. How well positioned are families and businesses to handle this? It seems not very well. Borrowing costs are going up, and the days of cheap money could be over. Refinancing costs are rising and have hit a global record. Globally, bonds are in decline, as seen with the recent crisis in UK government bonds. The corporate bond market is not coping well either. Interest rate rises are rattling investors and threatening corporate profits. As we mentioned, corporate debt is at all-time highs, and rising rates will make this harder to sustain. As the global economy is suffering through the after effects of the pandemic, through the war in Ukraine and other supply problems, corporate profits and personal incomes may suffer from rising rates.
So companies that can face pressure going into the new year will be particularly those unprofitable companies that borrowed excessively during the period of low interest rates back in 2020, at a time that we are starting to see a pickup in auto loan delinquencies.
So as the cost of debt rises, a bear market sets in more and more. It may well be that with the era of raising rates, the global debt bubble may be coming to an end. In the era of rate rises, it begs the question, what do I do with my finances? Should I save? Should I invest? Or pay down my debt? You could have so much in savings that it's a no-brainer to pay down your debt now that rates are rising.
Rising interest rates will continue to place pressure on the broader market, and as we've seen over the past year, the tech companies have been one of the hardest hit areas with regards to rising interest rates. Also, as well, the rate sensitive areas, particularly the housing market, will also come under significant pressure over the following 12 months on the back of these aggressive rate hikes that we've seen from the Federal Reserve.
Over the next few years, we're likely to see the consequences of rate rises and the buildup of debt during the pandemic. What we might be witnessing is the latest in an ongoing cycle of debt accumulation that simply will continue while we have a market economy. Thanks so much for watching. You can read more of our original market analysis by visiting our website, Capital.com. There's a link in the top right corner and also in the description. Don't forget to hit subscribe and hit the little bell to stay notified for films on similar topics in the future. I'll see you next time.